Always great to see you, Jan. Thanks for coming in.
Good to be here.
So some had gotten their hopes up after looking at some of the surveys and JOLTS, but clearly it just gets tight, right? Things are tight.
Well, this was a somewhat stronger report than expected. I don't, it wasn't too far away from expectations, but it certainly says the economy is still growing. The labor market certainly is still growing. That said, the decline in the unemployment rate did come alongside another more benign average hourly earnings number. We have now had two 0.3% numbers in a row. There is a gradual deceleration in average hourly earnings. I don't really see any signs of a wage price spiral here. And other data released this week, the job openings number earlier in the week suggests that the imbalance between demand and supply in the labor market is diminishing. Even with an unemployment rate that's still at 3.5%, we are seeing significantly fewer job openings, down almost 2 million. And I think that is important for where wages and inflation ultimately go.
Is there a magic number on that ratio per unemployed worker between 1 and 2 where things truly are clear and convincing?
So we were at 2. We're now at 1.7. I think we'll probably need to come down to 1.2, 1.3. That's sort of the numbers that we've been looking at in order to get inflation back down into maybe the mid-2s. And that's kind of the goal. We've made a substantial amount of progress over the last several months. And I do think that there's probably more declines in the pipeline. It's not going to be in a straight line because these are kind of noisy numbers. It was a very big drop in August. But I do think the trend is going to be down. That will help us re-equilibrate things.
So there's a nuance that I think is sort of getting mixed up in some of the mixed data we've been getting. So whether it's the jobs report today, whether it's some of the other macro data we've gotten this week or in the last couple of weeks, does the U.S. economy look like it's downshifting into a recession, or does it look like it is reverting to a pre-pandemic state of affairs, meaning a shift back to services from goods?
Yeah, I think the latter. I think we're seeing a deceleration towards more sustainable rates of growth and towards more sustainable rates of employment growth, towards more sustainable rates of wage growth. And right now, there's nothing that looks recessionary in the data that we're seeing at the moment. Now, doesn't mean we couldn't go into recession. It's definitely very possible. There are plenty of shocks out there that could push us there. But I don't see anything in the data that we're currently looking at that would say recession. Certainly not the jobs numbers, but even third quarter GDP looks like it's going to show a reasonable gain of close to 2% in our forecast.
When we talk about the possibility of shocks amid a aggressive Fed tightening cycle, are those shocks domestic, or are those shocks more likely to manifest internationally, especially in light of what we've heard from the IMF and World Bank in recent days?
I would say, I'd look at domestic shocks more. The United States is a relatively closed economy because it's so large. So most of the shocks that push the U.S. into recession tend to originate in the U.S. And obviously, the negative growth impulse from financial conditions, from aggressive Fed tightening, is sort of the prime thing to look at. So if something pushes us into recession, I think the most likely outcome is that, inflation surprises on the high side, the Fed has to do a lot more, and that pushes us into recession. That's possible, although it's not our baseline forecast.